All right, folks, a lot of headlines out today about the Japanese yen just really crumbling, if you will, to its lowest level versus the U.S. dollar, I think, since 1986. The big question, of course, is why is it so important? Why should we care about this? No one better to walk us through this than Bianco Research President Jim Bianco. And Jim, a lot of a hullabaloo, or but this is really critical. And I know you connect the dots, and I just want to share one chart before you even start the explanation, because we do see the U.S. 10-year yield and the Japanese yen, the spot price. They've traded in tandem until recently, and they've kind of gone their separate ways. And, I know obviously it's very critical because they've been major buyers of our treasuries.
Yeah, that's right. I mean, it matters if you're a leveraged yen trader, but I assume we don't have a lot of them watching us right now. So how does it matter for everybody else? The Japanese own over $1 trillion of U.S. Treasury securities. They're the largest foreign owner in the world, much larger than China. Their currency is weakening against the U.S. dollar. That's why the Japanese yen keeps going up in price through 160. That means they own $1 trillion worth of bonds that are losing value against their currency. The fear is if the currency continues to fall, they'll start selling those $1 trillion worth of bonds to invest in Japanese bonds. Why take the currency risk?
Right.
And so that's why you see that tight relationship between yields in the U.S. and the currency. Now, it broke recently because they intervened, and the market was thinking, okay, the Japanese government is going to try and manipulate the currency lower, or I'm sorry, manipulate the currency higher, the dollar lower, and that should help the U.S. Treasuries. But that's given way now. So now the concern is that this big foreign buyer might be less interested in buying Treasury securities.
And I got up the other chart just to underscore what we're talking about here, because for years, the blue line is China. They were the largest holders of our treasuries. And then more recently, they've started to aggressively sell, and the slack has been picked up by Japan. To your point, there was also this yield curve thing, right, where they removed the yield curve cap on their own bonds, making them more attractive. I mean, the yields aren't anywhere as close, but if you're a Japanese investor, at some point you may say, hey, these are attractive enough for me. And of course, at a time when our Federal Reserve just keeps printing, not the Federal Reserve, the Treasury, we're doing so many bond auctions. We need buyers, all the buyers we can get. And certainly if Japan walks away or starts to fall off, it's a big question mark, right? Maybe the Fed changes its mind quickly. Hey, I want to ask you something. There's a tweet, and I want your thoughts on it, from Market to Mayhem. So much money we don't even have has been spent fighting this normalization by an administration that is gaming the election, but not realizing the obvious. American families would rather have a moderate recession than persistently elevated prices. Do you agree with that statement?
There was a study done by some Harvard professors last month, and that they polled a bunch of people, and they said that the American public would be more favorable to a 1% rise in the inflation, in the unemployment rate, which is 1.7 million people losing their jobs, then another 1% rise in the inflation rate. And they talked about the psychological toll and the amount of stress that inflation has. Bear in mind, inflation impacts 100% of the population, where 1% rise in the unemployment rate impacts 1% of the population.
Right.
Now, this isn't going to be some kind of Hunger Games kind of thing where we're going to have to, decide which one goes first. But the point is, I think we underestimate the amount of psychological damage and how difficult inflation is for everybody. It's a big problem, and we tend to dismiss it, or we tend to think it's going away. But the public is telling you, no, we're really, really concerned about it.
And it's interesting because the Fed seems like they can't wait to pivot back to jobs, as opposed to, being, again, more focused on putting inflation away. Or, listen, the recession they were supposed to give us, it's ironic. Maybe we wanted it. We could have pulled the Band-Aid off this thing and been back to real normalization instead of this sort of engineered normalization. Jim, I love these discussions. Can't wait to talk to you again real soon.
Thank you.